Welcome to the deep dive. We are looking at the future of global energy today.
Yeah, but through a very specific lens.
Exactly. Our focus is on TotalEnergies. I
Yeah.
mean, they are just an absolute titan of the European energy sector.
Definitely. And to get a real grip on their current strategy, we actually have two very different sources on the desk today.
Right. One is this lively YouTube stock analysis from a channel called InvestiChan.
Which is great because it approaches the company strictly from a value investor's perspective,
Yeah.
looking at the raw market sentiment.
Yeah. And then on the flip side, we have TotalEnergies' official September 2025 strategy and outlook presentation.
Which is incredibly dense. It's the internal data-heavy roadmap straight from the executive suite.
It is. And the contrast between those two sources really gives us a solid framework. We're looking at a legacy fossil fuel behemoth that is attempting this massive energy transition.
Like going green.
Yeah, going green, but trying to do it without sacrificing its balance sheet or, its traditional investor payouts.
Which is the ultimate tightrope walk in the energy sector right now.
Totally. So our mission for this deep dive is to figure out how they are executing that dual strategy. We want to evaluate whether this massive transition makes TotalEnergies a smart, stable play for you if you're looking into value investing.
And really what it signals to you about the broader trajectory of global energy.
Exactly. Okay, let's unpack this, starting with a pretty notable quote from that InvestiChan analysis.
The midlife crisis one.
That's the one. The creator describes TotalEnergies as, quote, an old-school energy giant going through a midlife crisis but with solar panels.
It's a striking analogy.
It's pretty funny, too.
It is, though I'd argue midlife crisis might actually understate the structural necessity of their pivot.
Fair point.
Because to understand their strategic positioning, we have to look at the macro environment that they detail in their 2025 presentation.
Right, the global chessboard.
Exactly. The global energy market is currently navigating this really complex set of crosscurrents, particularly in oil.
Because the oil market just looks highly fragmented right now. I mean, the presentation highlights some very distinct short-term uncertainties.
Mostly on the supply side.
Yeah, specifically the unwinding of voluntary cuts from OPEC+. And that's running right up against abundant non-OPEC plus supply growth.
Right. And then you pair that supply dynamic with softer demand from Asia.
Because they're navigating all those trade tariffs and broader economic friction.
Precisely. So you get these crude inventory builds in both China and the U.S. It creates a lot of near-term noise.
So short-term volatility is basically guaranteed.
It is. But the presentation pivots quickly to the medium-term fundamentals. And they project those to be highly supportive.
Supportive for prices, you mean?
Yes. They model that from 2027 onwards, non-OPEC production growth is going to flatten out significantly.
Which puts pricing power firmly back in the hands of OPEC.
Exactly. But the more critical variable they point to is the shrinking global spare production capacity.
Right, because of the underinvestment.
Yeah. Years of structural underinvestment across the whole sector have left the market with very little buffer.
So if there's a supply shock...
The system feels it immediately.
But are they banking heavily on a slower than expected shift to low carbon alternatives? Because looking at the data, it seems customers are prioritizing immediate affordability over, accelerated green transitions.
They are factoring that in, yes. The affordability mandate is absolutely keeping baseline oil demand stickier than some of those really aggressive transition models predicted a few years ago.
Makes sense.
But the dynamic really shifts when you look at natural gas and LNG.
Oh, yeah. The presentation data points to a massive influx of new LNG supply coming online globally.
Right around 2027 and 2028.
So if we see that massive wave of LNG supply hitting the market in just a 2-year window, the immediate assumption is just a structural collapse in spot pricing.
Right. That would be the conventional wisdom.
Does the presentation address how they plan to absorb that kind of margin compression?
They do, and it's interesting. They actually view the anticipated price softening as a catalyst for demand generation.
Rather than just a purely negative margin.
Exactly. Natural gas has immense price elasticity in the industrial sector. So the presentation argues that lower LNG prices will actually trigger a massive wave of coal-to-gas switching in Asian markets.
Because when gas hits a certain price floor, it just becomes economically superior to coal.
Right. For baseload generation, it becomes the obvious choice.
And in the U.S. and Europe, they are modeling that cheap gas will accelerate gas-to-power generation.
To firm up intermittent renewables, yeah.
Which feeds directly into the power sector dynamics they outline. Global electricity consumption is just surging. It's compounding at a 3.3% annual growth rate.
It's massive.
We are seeing insane grid strain, and it's driven by things you literally see every day. Data center build-outs for AI.
The ongoing EV rollout.
Yeah, the EV rollout, heat pumps, the whole industrial shift toward electrification.
The grid is under unprecedented pressure. And that is exactly why this macro picture is highly relevant to you, the listener.
Yeah.
Because if you're trying to understand the market today, understanding this specific combination of chaotic factors is crucial. You have medium-term oil supply constraints, an impending LNG supply wave, and that 3.3% power demand CAGR.
It's a lot of moving parts.
It is. And understanding that chessboard is why TotalEnergies is hedging its bets across all energy types.
They are essentially building a portfolio that captures upside regardless of which specific transition timeline actually plays out.
Correct.
And the presentation codifies this into what they call their 2 pillars of growth.
Fueling the future.
Right. The overarching target is 4% annual growth in total energy production every year through 2030.
And 4% annual growth on a baseline production footprint the size of TotalEnergies.
It's staggering.
It requires immense capital execution.
So let's break down Pillar 1. That's their legacy business, oil and gas.
Right. And they project traditional hydrocarbon production to grow at roughly 3% per year.
Which, I mean, 3% growth in legacy fossil fuels seems slightly at odds with the whole green transition narrative.
On a surface, yeah.
But it provides the vital cash flow for Pillar 2.
Exactly. Pillar 2 is integrated power. And the target there is highly aggressive.
They're aiming to hit over 100 terawatt hours of electricity production by 2030.
What's fascinating here is the financial mechanism driving this expansion.
How they're paying for it.
Yes. TotalEnergies is utilizing the massive cash flow from its legacy oil and gas operations to directly fund its green transition.
It's just a massive internal wealth transfer.
Precisely. They are bypassing the need to raise expensive external capital or take on high-yield debt to build out these renewables.
It's a self-funding transition. But executing 100 terawatt-hour scale-up isn't just about allocating capital. It's about navigating grid interconnect queues, regulatory bottlenecks.
It's incredibly complex.
So how are they mitigating the execution risk on a build-out of that scale?
Well, their strategy relies heavily on targeting deregulated power markets.
Okay.
Specifically the U.S., Europe, and Brazil.
So by operating in merchant markets rather than relying solely on fixed power purchase agreements, they can leverage their internal trading desks?
Right. They want to capture peak pricing volatility.
But operating in merchant markets requires firm, dispatchable power. You can't capture peak pricing if your generation relies solely on wind and solar, because the sun might not be shining when prices spike.
Precisely. Which is why their power mix is deliberately structured. It's roughly 70% renewables, backed by 30% flexible generation.
Flexible generation meaning?
Things like utility-scale battery energy storage systems and gas-to-power plants.
Ah, okay. So they are actively internalizing the intermittency risk.
Yes. When the grid tightens and merchant power prices spike, their flexible generation assets can dispatch immediately.
That's smart. Meanwhile, on the gas front, the strategy is really heavily focused on volume expansion.
Very heavily.
They are adding over 15 million tons per annum of LNG from top-tier projects by 2030.
It's a huge capacity addition.
But does that aggressive LNG expansion expose them to long-term regulatory risk, particularly if the European Union accelerates its timeline for phasing out gas entirely?
It is a calculated risk.
Yeah.
But they're positioning themselves as a global gas aggregator, not just a European supplier.
Oh, I see.
So if European demand contracts faster than anticipated, their trading arm is designed to pivot those cargoes.
To Asian markets.
Exactly. Where that cold gas switching we talked about provides a much longer demand runway. They prioritize flexibility over rigid point-to-point supply chains.
Okay, let's shift from the operational roadmap to the financial perspective, pulling in the viewpoint from that InvestiChan analysis.
The value investing side.
Right, so TotalEnergies is currently trading at a PE ratio of 7 to 9.
Which is quite low.
Yeah, the market is pricing them firmly as a legacy value stock. It's not a flashy tech stock. They are seemingly discounting the growth potential of that 100 terawatt-hour integrated power pivot entirely.
True value investing.
Yeah, the InvestiChan creator compares their financial model to a diesel engine that refuses to quit. Or, that friend who never misses a rent payment.
That market hesitance is actually pretty typical for companies undergoing structural transitions. Investors tend to price in the terminal decline of the legacy assets while applying a heavy discount to the unproven green ventures.
Right. They want to see it work first.
Exactly. However, the internal financial metrics from their 2025 presentation suggest a highly disciplined capital allocation framework.
Staggering cash management, really.
Yes, they have targeted $7.5 billion in structural cash savings between 2026 and 2030.
And they're anchoring their net capex, their capital expenditures, to a strict range.
Streamlined to $15 to $17 billion per year.
But wait, if you were trying to scale to 100 terawatt hours of power while simultaneously adding 15 million tons of LNG capacity,
Yeah.
does capping net capex at 17 billion actually hamstring your growth?
It doesn't hamstring it. It forces hyper-efficiency. They aren't just throwing unlimited capital at projects to hit capacity targets. They are enforcing strict return on capital thresholds
So shedding marginal assets.
and streamlining core operations. It funds the expansion without inflating their capex.
Here's where it gets really interesting. How does that capital discipline translate to shareholder returns?
A dividend.
Yes, the dividend yield is hovering around the 5 to 6% range, and they maintain a cash payout ratio of over 40%.
It's a massive payout.
And the 2025 presentation literally uses the term sacrosanct to describe their dividend policy.
Sacrosanct.
Yeah, they are signaling to the market that these green transition costs are not going to cannibalize the shareholder payout.
Making a commitment to a sacrosanct dividend in a volatile commodity market is a bold stance.
Very bold.
And the only way a major can sustain that payout ratio while internally funding a massive transition is through relentless cost control.
In their upstream operations.
Yes. And if you look at why they can afford this,
Their upstream metrics are incredible. The presentation data shows their total technical costs are under $20 per barrel of oil equivalent.
which is very competitive.
But even more striking is the pure operating expense. The OPEX is sitting at less than $5 per barrel.
Maintaining an OPEX below $5 per barrel across a global portfolio is a structural moat.
It really is.
It means their break-even point is incredibly low. Even if we see a severe macroeconomic contraction and oil spot prices drop into the $50 range, TotalEnergies remains highly cash generative.
So that low break-in is the actual mechanism that guarantees the dividend.
Yes, and it's what funds the integrated power pillar.
But maintaining that level of efficiency requires operating in regions with massive low-cost reserves, which inherently carries geopolitical risk.
Absolutely.
I mean, just look at their global pipeline of major development projects feeding this machine. You've got Mero in Brazil.
Ballymore in the U.S.
Right, Telenga in Uganda,
Mhm.
and Granmorgu in Suriname. They are deploying billions of dollars into emerging markets.
Sovereign risk is the variable you have to underwrite when looking at these frontier developments, particularly in places like Uganda and Suriname.
Yeah.
But a major mitigates that risk through diversification and strict adherence to operational excellence.
Because you can't control the geopolitical environment.
Right, but you can control how you operate within it.
Which brings us to their safety metrics, the foundation of these operations. The presentation leads its operational sections with a strict objective of 0 fatalities.
And they track the data rigorously.
They really do. Between 2015 and 2024, they recorded a 75% drop in primary losses of containment.
Meaning major spills and leaks are down drastically.
Yeah. Additionally, their total recordable injury rate dropped by 50% over that same period.
Safety metrics are often the clearest leading indicator of overall operational discipline.
How so?
Well, if a company is lackadaisical about primary containment, they are likely bleeding capital through operational inefficiencies elsewhere.
That makes sense.
A 75% reduction in major incidents suggests a highly optimized engineering culture.
And if we look closely at that engineering culture, there's a fascinating metric regarding their workforce structure.
Oh, the employee ownership.
Yes. TotalEnergies is currently the #1 company for employee shareholding in Europe.
#1 in Europe.
Yeah. A massive 8.9% of the company's capital is held directly by its employees, and over 70% of the workforce are active shareholders.
It's a staggering statistic. And if we connect this to the bigger picture, it fundamentally alters the principal-agent dynamic within the company.
Because in heavy industry, misaligned incentives between the executive suite and the field operators often lead to capital destruction.
Right. And you also mentioned earlier from our notes that the company receives over 150 applications for every open position,
Oh, yes, I almost forgot that. Over 150 applications per open role. The employee buy-in is just phenomenal.
which means they get the absolute pick of the talent pool.
So what does this all mean? How does an 8.9% employee ownership stake and that level of talent demand actively change the way a platform or a solar farm operates day to day?
It creates an environment of localized capital allocation.
Meaning,
When the field engineer or the rig supervisor owns a meaningful stake in the company, their tolerance for operational waste or safety hazards plummets.
because they aren't just protecting corporate assets.
Exactly. They're protecting their own equity. It embeds a hyper-efficient owner-operator mentality deep into the organizational chart.
That structural alignment is incredibly hard to replicate.
Nearly impossible for a competitor to just turn on overnight.
So you pair that internal culture with the external strategy we've outlined, and a clear picture really emerges.
TotalEnergies is an absolute cash-generating tank that pays like a bond.
Exactly. It is successfully balancing a dual strategy. It's milking these highly efficient, low-cost fossil fuel assets to responsibly self-fund a massive pivot into deregulated power markets and renewables.
All while fiercely defending that 5 to 6% dividend yield, rewarding patient shareholders.
It is a masterclass in managing a dual-track strategy.
It is. But we have to offer a balanced synthesis here, because the InvestiChan analysis points out a critical caveat that every value investor must weigh.
The looming challenge.
Right. The ultimate risk to this thesis isn't their capital structure or their operational execution. It is the timeline.
The timing of the macro energy transition, peak oil demand.
Exactly. Can TotalEnergies grow its clean energy arm fast enough before global oil demand begins to permanently fade?
Because if demand contracts faster than their 2025 presentation models predict.
Does the legacy cash flow dry up before the integrated power pillar is large enough to sustain that sacrosanct dividend?
Right. They are betting that their $5 per barrel OPEX will allow them to remain the last man standing in a declining oil market, generating cash long after higher-cost producers are forced out.
But if the transition accelerates aggressively, that window narrows. They are basically racing to build a 100 terawatt-hour renewable utility inside an oil company before the underlying macroeconomics of crude oil shift permanently.
It is a massive execution tightrope.
It is. They have the balance sheet and the low-cost assets to fund it today, but the exact pace of the global transition remains the unknown variable.
This raises an important question.
Actually, I was going to say this raises an important question regarding the broader landscape of the energy transition.
Yeah.
Particularly when you look at the sheer scale of capital these legacy majors can deploy.
Right. And I want to leave you, the listener, with a specific dynamic to consider as you watch this sector evolve. We've talked about this diesel engine mentality today.
Yeah.
If a legacy oil titan can successfully fund its own green transition, funneling billions into flexible generation, merchant power trading, and utility-scale renewables, without even needing to tap the debt markets or sacrifice its balance sheet.
What does that mean for pure-play green energy startups?
Exactly. Does that mean the traditional villains of the fossil fuel era might actually be the most well-equipped and efficient entities to build our renewable future?
It's a provocative thought. Will the agile, innovative renewable companies be outscaled and forced out by the massive cash flows of the traditional oil titans?
It is definitely something for you to mull over. Will the future of green energy be democratized, or will it just end up as a new monopoly controlled by the exact same legacy giants?
It's the multi-trillion-dollar question.
It really is. Thank you for joining us on this deep dive into TotalEnergies and the macro energy landscape. We hope this analysis gives you a sharper framework for evaluating the transition strategies of these legacy industrial players. Stay curious, keep questioning the world around you, and we will catch you on the next deep